Daniel Lacalle has joined us. Welcome, Daniel. Nice to see you.
Good morning.
Penny, for your thoughts on this. Is this cyclical or is it structural? And if it's structural, that means Mark Reed, the new man at WPP, has got a job on his hands to shift this business model.
I think it is structural. The margins that Steve was mentioning before, the growth that Steve was mentioning before, is all those elements are gone. The pie is growing. The problem is that there's much more and more diverse types of advertising ways of reaching your customers without spending so much, and the margins therefore are going to continue to shrink. The digital revolution, different ways of accessing your customers, accessing networks. So it's completely different, and I think that these companies need to change the chip. They need to think, look, what we're going to do in the future is we're going to be competing against zero in many of the businesses that we used to charge very steep commissions and prices for. So it's a challenge, but not an easy one.
Absolutely, and look, and this would not be the right time for Mark Reed to say how great things are. This is the time for Mark Reed to say, I'm having a look at the business, and this is how I kitchen sink over the next 6 to 9 months as well. Let me just pull out one jurisdiction for it. And look, the company will point to that, to an improvement in some of the figures today, nudging the full-year outlook higher, returning to sales growth. That's what they're pointing to. That's what Reuters have picked up, and I'm picking up on a little bit further down the release, if I may. Like-for-like revenue growth, less pass-through costs in North America, i.e. the key big market, down 3.3%. Down 3.3% compared with a negative figure of 2.4% in the first quarter. Basically, they're coming under pressure across the board from a whole host of issues.
Absolutely, and it's going to continue that way. As I said before, the whole game is changing, and they need to be a lot faster and a lot more intelligent about how they look at the future, because it's not about size, it's not about being a big agency anymore. It's about being able to provide clients real bang for your money, which is what you were saying before, which is not very evident today.
Dan, thank you very much. Let's push on to emerging markets. Turkey's central bank has vowed to take action against significant risks to price stability, fueling expectations of an interest rate hike. The comments came after data showed inflation jumped nearly 18% year-on-year in August, topping expectations and marking a near 15-year high. The central bank's next meeting is on the 13th of September. No doubt closely watched, given Erdogan was standing in the way of those interest rate hikes. Argentina has unveiled emergency austerity measures in a battle to balance its budget amid a near 50% slide in the peso this year. Argentine President Mauricio Macri announced steep spending cuts and new taxes on exports. It's an about turn for the free market advocate who slashed agricultural taxes upon taking office.
Para cubrir lo que falta durante esta transición.
To cover what's lacking during this transition that has become an emergency, we're going to ask those who have more of a capacity to contribute. I'm referring to those that export in Argentina, that their share will be greater.
Sabemos que es un impuesto malo.
We know that it's bad, a very bad tax which goes against what we want to promote, which are more exports to generate more quality work in every corner of Argentina. But I have to ask you to understand that this is an emergency and we need your support.
Meanwhile, Argentina's Finance Minister Nicolas Duhovny is set to travel to Washington today to meet IMF officials to discuss speeding up disbursements of the $50 billion loan program agreed in June. Duhovny says the new measures will allow Argentina to achieve a balanced budget next year as he works to reassure the public over the economic turmoil.
I
want to speak to Argentines, to those who are watching us, worried with angst, not just to the markets. I want to tell you to remain calm, that this team is giving it our all so that Argentina can move forward, and that we're going to come out strong from this situation because we're coming out with a solid fiscal plan, having already corrected a great part of our external imbalance, and we'll be taking the steps to advance directly towards development in the way that will beat poverty.
Daniel Lacalle is with us. You've seen him once, chief economist at Tresis Gestion. Is it going to work, Daniel? Is it going to call off the dogs? Will the bond market vigilantes go away?
It's very, very difficult. And the reason why it's very difficult is because it's not this government's fault. The Macri inherited an economy in which the previous government doubled government spending to GDP, increased money supply monstrously, getting to an inflation of 30%. increasing money supply by 30%, printing pesos like there's no tomorrow, and left this massive fiscal and monetary hole. That now it's very, very difficult to correct. So the previous government doubled government spending to GDP. He's going to cut it by 0.7%. They call it austerity. It is unfortunately not. And the problem continues to be the elephant in the room, which is exactly the same problem in Turkey, which is that the central bank continues to print, in the case of Turkey, liras, in the case of Argentina, pesos, massively to pay for a bloated government spending and subsidies and all types of handouts, while reserves are falling because all those taxes that they are increasing, all those limits to growth that they are putting are not working. So you lose your reserves, you print more money, inflation goes through the roof. It's unfortunately a very difficult one. And before the Central Bank of Turkey, the Central Bank of Argentina were betting on a weak dollar, inflow of dollars, cheap money, party like it's 1999. Guess what? That's gone.
So what happens from here for emerging markets? Because we keep talking about them all together, despite the fact that Argentina might be a specific example, Turkey might be a different one altogether, a homegrown crisis, but yet the sell-off has swept right across a lot of the EM currencies.
Yeah.
What do you make of what investors are seeing? Is it too much pessimism at this point?
I don't think that there's too much pessimism, because it comes from too much optimism. And it comes from too much optimism. We've seen years of inflows into emerging markets, betting on a growth that is being revised down, betting on a weak dollar, betting on very low interest rates. And now that the tide is turning, we start to see some problems. I think that the way to look at it is to look at which countries have increased their imbalances more in the last years. Brazil, India, Argentina, Turkey, all these countries that have taken a fiscal stance towards deficits, towards trying to grow more than they could actually, and at the same time increasing their imbalances, are the ones that are suffering. So I think that we have to be at least cautious, because the pace of rate hikes is not changing, but at the same time you have a massive maturity wall in emerging markets, in the dollar debt that at the same time is being more difficult to repay as the environment gets a little bit less exuberant. It's not about recession. It's about basically less optimistic expectations of growth, and less expectations of growth in an environment in which Brazil, India, Argentina, Turkey, all those countries went into massive imbalances, particularly in 2017. You have a bad combination, in my opinion.
I can tell you're quite passionate about the EM space at this point, Dan. I'll have another go at it in a bit, but in the meantime, coming up on the show, we'll be speaking with Redrow CEO John Tutt as the British home builder calls for more Brexit clarity in its latest earnings. That's a first-on interview coming your way.
On that, John, thank you.
Thank you.
Very quotable. Stick with the devil you know. John Tutt, Group Chief Executive at Redrow.
Yes, well, we've still got this job, isn't it? Right, Italian Economy Minister Giovanni Tria is calling on governing coalition lawmakers to keep next year's budget deficit to below 2% of gross domestic product. That's according to a Reuters report. Deputy Prime Minister Matteo Salvini has earlier said that the deficit could reach as high as 2.9% of output, just under the limits set by the EU. Let's have a look at the Italian bond yields and where they're currently trading. People are talking about the expansion over bunds and the width of the spread over bunds, of course, but we're nowhere near the crisis levels we were previously. Look, Daniel, I haven't got the yields, but I have got this. I've just downloaded a 97-page report on Italy. I'm out there at the end of this week on the economy. I mean, what can you tell me in 2 minutes that City's trying to tell me in 97 pages?
Basically that the challenges to grow the economy are very, very high and continue to be difficult, because the non-performing loan weight and the exposure of banks to sovereign debt create this constant problem in, let's say, making the monetary policy of the ECB flow into the economy. I think that also what you have in Italy is, in general, a problem of stagnation that has nothing to do with the new government or with the previous. It's been ongoing for 2 decades. Basically, the Italian economy is very simple. You subsidize low productivity sectors and you tax high productivity sectors. It's a combination of stagnation, and unfortunately that has to change, and it's not in the budget or in the next 4 years.
Had something apparently which came and went. It was called the GFC, the Great Financial Crisis. Apparently a lot of the ills were solved.
Yeah. No, not really.
Why are we still in this bog that's Italy?
Well, because it hasn't been solved. What it has been is disguised. No, we have seen with the bailout of Greece, with Italy, with Spain, with Portugal.
Italy never had a bailout.
No. With the bailout of Greece, with Italy, with Spain.
Should Italy have had a bailout?
I don't think that Italy should or Spain should have had a bailout. I think that the first problem was a problem of competitiveness that has never been addressed. It has been addressed through lower yields and through monetary expansion, and it hasn't been taken by governments to improve their fiscal stance. In fact, Italy does have a primary surplus, and Spain is almost at primary surplus. But it's basically because what they have done is to increase taxes and to keep spending more or less where it was. So what we need to do is to change the mentality in the Eurozone. The Eurozone continues to be more focused on keeping government spending at any cost, and it's still keeping companies and families very, very much in a very difficult position.
So the fear is then, as we talk about divergence between the United States and everything else, and an EM crisis that could be unfolding, what happens to some of the weak spots in Europe? Are we right back to where we started, where the market then has a run against the likes of Italy, because whether it's government policies or a budget that can't be balanced, they have a go again. The market tests the resolve of local governments and Mario Draghi.
I think that it is quite unlikely that we will see markets taking aggressive moves with European countries, because if you look at the fiscal balance, for example, considering what the ECB is going to be doing, the net needs of financing of most European countries are actually very small in the next years, because the ECB is going to repurchase what matures. No, therefore, I don't think that we're going to have a debt crisis typical of what we saw in 2011. However, I think that what bond yields are showing is that despite massive liquidity, let's remember that the ECB is now 41% of GDP of the Eurozone, its balance sheet, compared to 22% more or less than 22% of the Fed. What we will have is an environment in which what we have is debt saturation. So we're more likely to see a Japanese stagnation type of outcome rather than a 2011 crisis.
But all these guys have got is a very big hammer which says easy money, liquidity.
Yeah.
If we go into a European recession with near zero interest rates and a QE program on the go, how does the ECB react to the economic crisis? Do we get negative rates? Do we get some other form of exciting monetary policy that we haven't quite conjured with at this stage? Because there is no doubt about it, they will be under pressure to respond and do something, whether Draghi is still there or not.
But the response is not monetary. The response has to be fiscal. The response has to be of governments stopping to think that they're going to go back to 2005. The governments need to think of the future. They need to attract high productivity sectors. They need to attract capital. They need to attract jobs. The Eurozone has double the US unemployment rate, with the balance sheet of the ECB being 41%, double that of the Fed at the same time. So it's not going to be monetary. I mean, the history of negative yields is a disaster, because negative yields obviously don't make people take more risk and invest more. Negative yields actually make everybody a lot more aware that there's tremendous manipulation. So that's not going to work.
Dan, thank you very much for that. We are counting you down to the start of the European session. About 30 minutes to go. We'll be right back to get you set up for the trading day.
So isn't it that there's tremendous life ahead and great opportunities, but that they're being a little bit too greedy on pricing and too quick on development of new products, so the consumer doesn't catch up? And what ends up happening is that you don't reach the optimal level of sales or the level of penetration on a product that has just been launched, because you need to immediately launch a new one to try to cover a margin that maybe was just perfectly good. It's just too optimistic.
No, absolutely. The consumer, Samsung will release this. This won't be a mass market product at all. But what they want to show is we can still innovate, we can still excite the market, and therefore charge those higher prices. So those are the kind of things they want to achieve with this phone, rather than perhaps making this a mass market product as of yet. But potentially in the future, we could see this kind of technology take off.
Arjun, plenty more on that story too on the web. Go to cnbc.com to read about the foldable coming away in November. And we're counting you down to the start of the European session. Signals are for a positive start. So we've got about 4/10 now on DAX futures, which is really improved from about a 2/10 level. Stay tuned, the numbers coming your way.
Thanks very much indeed, Karen, for that. Chris Bailey has joined us, European strategist at Raymond James. Daniel Lacalle is here, of course, as our guest host. Can I throw you straight into a knotty debate about valuations, Chris, at this point here? Because it is almost like given wisdom that there is a valuation disconnect between Europe and American markets. And yet not everybody agrees that that is real value. Some people around this desk, I suspect, think that there is a value trap. But let me get you to weigh in on this one. Should I be looking at Europe at the moment as a value opportunity?
My view would be yes, and I say that for two reasons. The first reason is that everybody hates it. And when everybody hates something, what is it, 25 successive weeks of outflows? Everybody hates Europe. That therefore means there's going to be some interesting companies at an absolute minimum. You can pick through as a stock picker and find something of interest. The second aspect is people don't believe that there's a future of a sort of a dynamic regional zone, because everyone looks at Japan and says, look, Europe is the next Japan. You know, you've had over the last 25, 30 years in Japan a lack of dynamism. This is Europe, all this angst over the next step for the European Union, the Brexit negotiations, Southern Europe's banking problems, etc., etc. It's just the value trap forming. The thing is, though, European politicians do have an opportunity, and that opportunity is learning from the problems of Japan and actually applying something which is a bit more interesting and ultimately fires up investors. So I would say, from a contrarian perspective, you should be looking at Europe, and I retain, and I admit it, I am a glass half full sort of guy. I retain optimism that actually there's going to be an okay European future out there, even without the UK in the European Union.
I'm going to be on the flip side of that argument. The first problem is that European politicians don't see Japan as a problem. They see Japan as a solution. They think, hey, Japan has low unemployment. Yeah, it has stagnation and high debt, but the government spending is enormous, and we love enormous government spending, and we love enormous conglomerates with no growth that are close to the government. So let's go for it. I think that the value trap problem in the European Union, indices, is in the very large caps. So I would agree with you. You have to be a very good stock picker, because you have to look, sort of below the mega caps. Now, the problem that I see is double. The mega caps have underperformed dramatically, and the banks, of course, and deservedly. Earnings growth is inexistent, earnings downgrades continue, and valuations are, let's say, optimistic based on all the earnings that they've bought in emerging markets at premium multiples. However, the problem that I find is that the good companies, the companies that are actually in the club that you mentioned, they've done phenomenally. They've actually done better than the US ones, and they are actually trading at higher multiples than the US ones. So the issue that I have is, if I have to look at value in Europe today, most of what I am going to be looking at are the value traps, the telecoms, the conglomerates, the utilities, the banks, and that's a dangerous one to look at.
Let me start with Daniel and Chris to come in here. What about the very basic point that these are companies in Europe rather than European companies, and i.e., a company in Europe that is doing the same as a company in the US is being valued as a European company as opposed to a US company. Do you see what I'm saying here?
Yeah.
I.e. they're on international markets, they're doing exactly the same things, but they are being classed because of their home-based jurisdiction. Is that not an opportunity?
No, I would disagree. And the reason why is because all CEOs all over the world deny the headquarter effect, but it exists. It's called cost of capital. And there's a second one, is the lack of identification between minority shareholder and management. Managements in the US buy back stocks, own a lot of stock. They actually care about the minority shareholder. Managers in Europe, basically, as a good investor friend of mine tends to say, are VIP employees.
Chris, do you want to come in on that point?
So I would say two quick things. The first would be, actually, when you scrape away the valuations, I would agree, there is a discount. Dan was absolutely right. There's a top tier of European companies, very global companies, where valuations aren't dissimilar from those in the States. But when you scrape below that surface, particularly the slightly more cyclical companies, because Europe's been slower growth, there is a discount. Second is, I think we're coming up to some critical moves now. Daniel correctly mentioned Japan and the mess that there's been there. The European Central Bank is trying to break that sort of setup with its policy over the next year with stopping QE, and ultimately it will raise interest rates. Now, it's clearly still a very, very loose policy, clearly very stimulatory in nature, but ultimately I think that's what they've learned from Japan. You can't have mega permanent stimulus. If you do, that isn't a future. Yeah, particularly when you've got a declining population.
Governments are not letting that happen. Look at Spain, look at Italy, all of the governments that are in Portugal as well. Governments are pushing for higher fiscal imbalances in order to present themselves as too big to fail so that the ECB does not stop the policy. And that is a very dangerous path, which is not dissimilar to what the Keiretsus did in Japan. The mega conglomerates actually forced the government to overspend because they were actually going virtually bankrupt because they overspent themselves. So, I understand your half full glass situation. I think that my problem is that when I look at Europe and I look sector by sector, the companies are not more significantly cheaper than the US one. Only the technology giants, and there's a reason for it. Obviously, Facebook, Google are not the same as an index, the Stock 600, that has less than 7% technology. But in oil, pretty much the same multiples. In telecoms, in telecom and communication, not information technology, pretty much the same multiples. In consumer, pretty much the same multiples. We're not seeing dramatic differences, whilst the identification between minority shareholder and management, to me, is actually quite important.
I would say, though, the difference will be is because what you've got embedded into the future expectations is so muted in Europe. There's this feeling that European earnings growth is going to be low single digit, and hence when you look at the prospective ratings, that's what's factored in. Mm-hmm. The surprise quotient might be that Europe does a little bit better. And actually, you scrape away some of the tax reform changes in the States, European and US earnings per share growth is actually not wildly dissimilar, albeit Europe's coming from a very, very low base. But that's a starting point. As they want to look at European cyclicals, that isn't factored in. What isn't factored in is Europe doing a little bit better, a bit better than that sort of 1.5% growth. Mm-hmm. If that happens, then Europe might surprise.
But
I find opportunities.
Earnings surprise is actually not very poor. It's actually atrocious. Earnings surprise in Europe in the last 2 quarters have been extremely bad in the year that had all going for earnings surprise being better than consensus, no?
Well, the thing is, you've got the lagged impact of the stronger euro, and now that's working itself out because the euro has fallen. Second, of course, we can debate Q1 earnings growth impacts and things like that. Certainly things like the bad winter impacted. But let's not take away from the fact that Europe politically hasn't got its act together. You saw from the PMI numbers yesterday in the quotes that the confidence levels have become more muted as companies and politicians are just not confident about the future. But we start from a very, very low base. As I say, 25 weeks of outflows from European equities, that's kind of interesting to me. When I look at the non-discriminatory nature of those outflows, I start seeing stock-picking level opportunity, and that can segue into something a bit more interesting.
Gentlemen.
If European politicians get their act together.
Anchors here doing nothing. Do you just want us to get in or not?
I thought you guys were just listening to the
We
debate.
love it. We still
I've
get
been
paid.
looking at a chart, the stock strip 600 for the last 5 years, and you might be right in that if there is a change in sentiment, you can see this index move very, very quickly. There's huge spikes, but also huge falls, which is also alarming at the same time. But what you've had this year is the market coming off a little bit, but then ultimately it's not too far off the highs that we had in 2015. So what sort of year is it? Is it a 2015 year yet again where you see more highs because you'd really have to see a fairly large spike to take us back to those levels, or is it something else? Is it the lows that you've got on that chart around 2016?
It's funny,
might actually be helpful if we could show you a 5-year chart and a 12-month.
Well, it's funny actually, because that was the point I was coming to, but we got onto some really interesting stuff over the last few minutes. But the reality is, it feels like to me late 2015, early 2016. I say that because when I speak
Which
to...
is when we had the lows on the chart.
Precisely.
Right.
When I speak to my colleagues in the States, they're very similar in terms of their tone. Very pessimistic towards Europe, very optimistic towards US assets and related. And I put that together in terms of the surprise element. And we're starting to see some of the economic surprise indices moving up in Europe. And that is an opportunity. Now, for it to follow through, you're going to need to see some progress on some of the big issues. Brexit, obviously, but where does Europe go in terms of reform as well?
Chris, which means we have to park the idea of divergence and talk about catch-up in markets if your theory is to play out. But we'll come back and talk about this around the set in just a minute. Coming up on the show, Facebook has promised to do more to protect users from foreign interference. Find out what the tech giant plans to do ahead of the midterm elections after the break.
I think that restructuring stories are always complicated and very, very challenging to deliver on such big differences. But I think that what gets the market more scared in this particular environment is margins, is that inevitably the restructuring story means that those 13% margins that we saw before are going to come down probably to 10, and that's a big fall. So if you can't bet on earnings and revenue growth, and you can't bet on margin expansion, its multiples are going to compress. So as you very well say, a turnaround story will take some time for people to actually digest and believe that it's going to happen the way it should.
Chris, what companies that are best of breed in Europe at the moment that are must-haves in anybody's portfolio?
So I think for me, when I look at best of breed, you're looking for opportunities. There's no point in picking the things which everybody else owns. And for me, when I look what's going to surprise, it's going to be cyclicals, because that's the bit that's compressed at the moment. Any expectations about future European growth is very compressed. And so for me, when I look at companies like Lafarge Holcim, Saint-Gobain, for example, I see opportunity. I see shares which are undervalued today, paying dividend yields, sensible managements, occasionally getting a bit of a nudge from activist investors. So for me, I'd be looking for that sort of opportunity.
Anything in the oil space?
Well, oil is interesting because I think oil prices clearly have firmed up over the last year. Our view is that oil prices do go higher, and therefore where you would be classically looking would be for E&P and oil services. Now, in the European markets, the pan-European markets, the oil services names are probably of a bit more interest, a bit more relevance, rather than the integrated ones. So oil services companies, particularly when they've got a sensible balance sheet, which is always the big problem with oil services, are good. So John Wood is still a turnaround name.
Chris Bailey, European strategist at Raymond James, thank you very much indeed. Another treat for you coming up. We're going to speak to the BlackRock Vice Chairman and former Swiss Central Bank Governor, Philip Hildebrand, as questions rise over Mark Carney's future at the Bank of England. That's first on after this break.
Can I disagree? The biggest threat to the economy is not Jerome Powell, and it's definitely not Donald Trump. The biggest threat to the economy is extremely loose monetary policies that have created these enormous bubbles. The problem that we're seeing in Argentina, the problem that we're seeing in Turkey, the problem that we're seeing in Brazil comes from those countries hearing over and over and over and over again that trade deficits don't matter, that debt doesn't matter, that dollar flows are going to come in no matter what, that despite the fact that the Fed, as you very well said, has given for years, path of rate hikes, it's not going to happen, that this time is different, and then it is not. And unfortunately, what we have right now is an environment in which all central banks, including those of those countries, have exceeded their policy by injecting money into the economy, and now what is coming out is a lot more challenges. And I think that is the problem, not trade wars. We've lived in a trade war since 2001. The protectionist measures of G7 countries have rocketed.
Yeah, first of all, no central banker has ever said policy will never change. In fact, the Fed has been extremely transparent about that it is on a tightening path and has been very consistent. And secondly, you see very well that certain emerging countries in Asia, you look at Korea, you look at Taiwan, they actually post pretty good numbers. So I think, again, this is a story about a more challenging environment because of tightening, but that's normal. We have overarching risks around trade, and you have some very exposed countries. That's really the way we should look at this.